Thank you, gentlemen and ladies and gentlemen. My name is Juha, the head of London office at Korea Housing Finance Corporation. It's my great honor and pleasure to be here representing Korean whole economy and the housing market and global market as well. Today's presentation will be like this: first Korean housing market and Korean RMBS mortgage, residential mortgage market and global market, and I will deal with the Korean ESG market briefly. Let's begin with the Korean housing market first. Korea's housing market is relatively stable thanks to the proactive government oversight aiming at managing market volatility and minimizing the potential debt risk. The mortgage growth has been steady, maintaining an annual rate of around 5%. And although we saw the uptick in delinquency rate in 2023, triggered by the rapid rise in interest rate, delinquency rate levels remain low by historical standard. According to the OECD data, compared with other advanced countries, Korea has maintained the stability in real estate housing price and the price-to-income ratio as well, though largely due to the ongoing government stabilization measures. Let me draw your attention to the couple of key points here. Look at the OECD data, Housing Price Index and Korea Real Estate Board Sales Price Index. Those two indices have both suggest that housing prices have largely returned to the pre-COVID-19 levels, and generally, housing price has been stabilized in 2021. However, there is a noticeable divergence between Seoul and non-Seoul areas. Recent housing prices in Seoul appear to bottomed out and are beginning to rise again, while prices in other regions remain relatively stable. However, transaction volumes are still under pressure. The government is also actively pursuing initiatives to expand the housing supply across the nation to meet the increasing housing demand. Looking ahead to 2025, the several factors will shape the housing market. From the perspective of demand, stricter regulation and tighter household debt management are expected to limit borrowing capacity from the borrowers. Housing supply has declined notably since 2022, and ongoing concern in real estate finance project sector could constrain supply further. Due to the government regulations on multiple home ownership, demand is shifting toward the single high-value properties in prime location. So, the trend is expected to polarize demand. From now on, I look at the Korea's residential mortgage market and couple market. Historically, Korea's mortgage market was led by commercial banks and dominated by the short-term adjustable rate balloon payment loans. In the early 20s, more than 95% of the mortgage were short-term and adjustable rate and lump sum payment and maturities, exposing borrowers to significant interest rate risk and refinancing risk. To improve the vulnerable household debt structure, Korean government set a clear policy direction to encourage the high long-term and fixed-rate mortgages. In 2024, KHFC was established as a policy arm to implement this strategy. So we introduced the HF mortgage, long-term fixed rate, and fully amortizing mortgage loan in 2004. KHFC plays a dual role, supporting banks by developing mortgage-backed securities and couple market as a principal mortgage funding sources. And also, we are also offering affordable mortgage for low and middle-income families. KHFC mortgages have a strict eligibility criteria. It should be all fixed rate and fully amortized. And maximum home price is 600 million Korean won, which is approximately $455,000 US. And combined annual income should be within 70 million Korean won, which is around 53,000 US. And loan term should be from 10 to 50 years. We also provide a preferential rate for the household with multiple children and single parents and multiple multicultural families and the members with disabilities. To avoid the potential market distortion, KHFC focused on first-home buyers and underserved segments and middle and low-income families. On the other hand, the general commercial bank catered to the wealthier and multi-home owning clients. Due to the government's effort to restructure the market, the share of the fixed-rate mortgage meaningfully increased. As of April 2024, the poor fixed rate increased to 23.1%, but still adjustable rate mortgages account for 56% of the market, while hybrid loans make up 20.9%. But if you include hybrid loan with 55-year fixed rate period, the share of the fixed rate mortgage increased to significantly around 52.5%. Looking more closely, KHFC supplies we can see that the Korean mortgage market is severely polarized. KHFC supplies 85.7% of the all poor fixed-rate mortgages, while banks issue nearly 88% of the adjustable-rate mortgages. The Korean government seeks to further raise the share of the fixed-rate lending. To further involve the private sector and meet the policy goal, regulators introduced the key measures. First, encouraging banks' participation in domestic covered bond market. Second, offering zero-risk rate for covered bond investment. And third, providing KHFC payment guarantee for covered bond issued by the Korean major banks. Let's take a look at the development trajectory of the Korean covered bond market. The first Korean covered bond was issued by KB Bank, the commercial bank, in 2009. It was in a structured covered bond format. And in 2010, KHFC issued the first statutory covered bond under the KHFC Act. And following the Korean Covered Bond Act in 2014, Hana Bank and Shinhan Bank have joined the cross-border covered bond market in 2021 and 2024, respectively. Let's look at the ESG bond market in Korea. As of 2024, outstanding ESG bond in Korean's domestic Korean won market total 260 trillion Korean won, of which 83% of them are social bond. But the green bonds are gaining its momentum, representing 13% of the 2024 annual issuance. Unfortunately, sustainability-linked bonds, so-called SLB, have yet to gain traction in Korea. So far, only SK Hynix, the global leader in semiconductor manufacturing, issued the SLB. The main reason is actually very straightforward. The many Korean issuers are hesitant to set ambitious goals. They have some concern about the potential penalties if they fail to meet their KPI. For your information, KHFC is the largest Korean ESG bond issuer, accounting for more than 14% of the total Korean GSSS bond issuance in the global market. And also, according to the Environmental Finance, KHFC is the largest social bond issuer globally, and the largest agency issuer with $20.1 billion in bonds. Korea also has the robust green certification system like Europe. G-SEED measures building eco-friendliness across the diverse dimension, and BEAC focused on carbon dioxide emission and energy uses. In 2021, Korean government introduced the K-taxonomy, the voluntary framework aligned with the EU taxonomy. It was updated in December 2024 to include the goals on water conservation and circular economy and pollution control and the biodiversity. Notably, G-Seed is compatible with the LEED and BREEAM in Europe and in the US, aligning Korean standard with the global best practices. The Korean issuers typically structure their green bond based on the second-party opinion derived from G-Seed evaluation result. For your references, KHFC also launched a new green product, mortgage product, aligned with the G-Seed in 2023. So I believe that KHFC is approaching readiness for our first green bond issuance. And the momentum is building, and with the right preparation, we could be well positioned to enter the green bond market soon. For those who are not familiar with KHFC, I will here briefly introduce KHFC. KHFC is an SSA established under a special act called KHFC Act in 2004. Our mission is to promote the housing welfare of the Korean people by ensuring long-term stable supply of housing finance. We are 100% owned by the Korean government and Bank of Korea with strong legal backing. Under the Article 51 of the Korea Housing Finance Corporation Act, any financial loss is guaranteed by the government. So KHFC is the sole Korean MBS issuer in Korea and leading the Korean covered market development. This diagram well explains the KHFC securitization business. It shows how KHFC operates similar to Fannie Mae and Freddie Mac in the US. We benchmark the Fannie Mae model, basically. KHFC we don't lend directly money to the customers. Instead, we provide underwriting guideline and purchase eligible mortgage loan from the banks and fund them through the issuance of covered bond and MBS. In terms of asset pool quality, the average loan-to-value ratio is 56.8%, and the DTI ratio stands at 28.4%. The average loan amount is 128 million Korean won, which is approximately 85,000 euros something. So when it comes to the issuance volume, from 2010 to 2022, KHFC's annual covered bond issuance in the global market was around 500 million. However, starting in 2023, we significantly increased our issuance. In 2023, the total annual funding, including covered bond and senior unsecured bond, reached around 4.3 billion euros. And if we include the Korean won denominated MBS, the total annual issuance amount reached to 20 billion euro. KHFC entered the Swiss franc market in 2022 and Aussie dollar market in 2023. That same year, we also began issuing senior unsecured bond for the first time as a part of a strategy to broaden our market exposure. Last but not least, before I conclude, I'm proud to share that the KHFC opened our London office last month officially. So our new office will conduct market research about Europe, and we will focus on strengthening international cooperation with the investors and institutions like you here. So if you find yourself in London and you have any ideas for cooperation to come to mind, I'd happy to connect with you. I warmly invite you to my office. Thank you for the listening.